Hey guys, Jake here, and in this video I'm going to be talking about how the infinite banking concept can help you retire tax-free. Now, before we jump into exactly how it does that, we first need to talk about taxes in general and some of the things that are going on there. So the question is essentially to determine if retiring tax-free is even a viable option or something we should even be considering. We need to understand if we think taxes are going to go up or if they're going to go down. So let's talk about real quick what's going on with taxes. I'm going to talk about three particular areas. I'm going to talk about how the government affects taxes. I'm going to talk about how the Federal Reserve affects taxes. And I'm going to talk about how your personal economy or your personal finances affect taxes. Okay, these three areas are very, very important. So to help me with the first, we're going to go to usdebtclock.org, and you can go ahead and check that out. There's going to be a lot more on there that we're not going to cover. But the usdebtclock.org is essentially the real-time data that shows the U.S. national debt. So if you look up here in this top left corner, you'll see U.S. national debt. And right now it's $17.7 billion as of September 2014. Okay, you'll also notice the U.S. federal budget deficit is $554 billion. In other words, what they're spending that they're not taking in on tax revenues. So it's the money that they're spending that they don't have as of this year is $554 billion. Okay, so a large amount of money, but what's more interesting is when you break that down on a per citizen or per taxpayer level, and they've done that here. So if you look at debt per citizen, so every citizen of the United States, their share of this debt is $55,000. And of the taxpayers, those that actually pay taxes, is $152,000. So kind of putting that in perspective, what $17.7 trillion is, which is obviously a lot of money, each and every one of us who pays taxes would actually have to pay $152,000 to pay that off. Okay, so that's the liability that we owe and that the government needs as revenue. Now, obviously, the government doesn't have, isn't profit. It's not necessarily a profitable entity in that it produces. It actually just takes from the economy. So it's going to need that revenue from people like us who are taxpayers. And ultimately, at the end of the day, whatever that national debt is what we are going to have to eventually pay as taxpayers. There's no one else that can pay it. The government has created that obligation, but we are the ones that owe it. So if the government needs money, it's going to come from us. The other area to look at is down here in the bottom. It's U.S. unfunded liabilities. And what this represents is a little bit different than the national debt. It's all the liabilities that the government has, what it has promised to give in the future, like Social Security benefits, Medicare, prescription drugs, all of these things that they promised to us. This is what they owe. So $116 trillion is what they owe there in the future, and that's obviously not a bill for today or that's been spent today. That's what's been promised in the future. Breaking that down to individual taxpayers, that's $996,000 per taxpayer that the government has promised will be paid to for these types of benefits. So close to $1 million per taxpayer. Now, you could break this down into a lot of different things, and you could, there's probably, you could go 100 times deeper. But the point is that we're spending more than we take in, the government is. They owe a lot of money, and it's continually increasing, and they owe they have a lot of obligations that are not yet fulfilled. And since we're the ones that have to fork the bill and actually, we bring in the revenue for the government, they're going to have to come to us if they need additional revenue, okay, or they're going to need to stop spending as much. And so, if we're to look at it, the question, are taxes going to go up? Well, the question as it relates to the government is, for you to determine. But is it going up or is it going down? I would say that in the case of the government, there's a higher likelihood that the taxes are going to go up simply because the needs, the revenue needs. And we're actually already seeing that. In fact, if we look at our tax brackets, here's kind of a history of U.S. tax brackets. you'll see that they've been kind of up and down, but what you'll see is the red bars here represent the average, the maximum tax that we pay. And then there's an average here, 58.4% is the average maximum tax rate that we have paid in history. Okay, right now we're just under 40%, you can see here, towards the end in 2013. And then in the white here, or this off-white, is the the lowest tax rate. So 11.7 is the average minimum tax rate in our country, and right now that's lower here. It's just around or under 10%. Okay, so what you'll notice is that through the the 30s, 40s, 50s, 60s, even up until the 80s, the highest tax brackets and the lowest tax brackets were significantly higher than they are today. They've actually come down significantly, and in the 2000s they came down quite a bit. But we're seeing them start to step up again. And so, as you can see, we've had a history of almost higher tax brackets and even up till recently lower ones. And so it's kind of a just seeing the graphical layout here, it's almost easy to say, well, we've been in low tax brackets compared to history, so we're going to need to bump them up. And so the point here being, based on history, we could see that there's a good likelihood that tax rates could go up, and in comparison, it wouldn't seem as bad for the government to do that. So the second item is the Federal Reserve, and the Federal Reserve meaning how they manipulate the money in our economy. And ultimately what it boils down to is inflation, and how the way that they manage that money and the money they put into the economy and the money they pull out, when they do that, how that affects our income, and ultimately what the manipulation of our money, or the money in the economy, the manipulation of that boils down to basically inflation. If there's too much money in the economy, then we can see increased inflation. We're seeing a lot of that recently. But ultimately, the Federal Reserve regulates that to a certain degree. So inflation becomes a big factor on income. So if you have income today of $100,000, well, if your income keeps up with inflation, that's what we're going to kind of look at. If it keeps up with inflation, then chances are that alone is going to bump you up into higher tax brackets. So let me jump over here. So let me jump over here into this document. So this document, you can download it below. But essentially what it shows is it's data from the U.S. Census Bureau, and it illustrates inflation versus actual income over the last, so about 40 years or so. So let's go ahead and pick, I'm just going to jump back 30 years so we can see this full thing. But if we jump back to 1981, you'll see that the actual income was average income was $17,923 of income. So the paycheck said $17,923. Well, inflation adjusted, meaning what it would feel like today to get that paycheck back then, that would have to equate to $45,260. So in today's income, that $17,900 equates to $45,260. So as we follow that up, as we jump that up, as we scale up to 2011, we'll see that the take-home income was at $49,000, inflation adjusted 50, just year-end numbers. That's why there's a little discrepancy there. But essentially the point is $49,000. We've gone from $45,000, $45,000 of take-home income to $50,000, meaning we really increased that take-home income, what it feels like, about $5,000, but the nominal, or the actual paycheck itself, has gone from $17,900 to $49,000. That's 2.5 times what that paycheck was before. So while we're not making necessarily a lot more money, or it doesn't feel like we're making a lot more money because of the inflation, the actual paycheck is increasing, okay? So if indeed that is the case, if your paycheck will go up because of inflation, then if you make $100,000 today and you make 2.5 times that to keep up with inflation down the road in 30 years, then you're looking at $250,000 and maintaining basically that same lifestyle that you have today. So inflation alone, if your income keeps up with inflation, then likely you'll see an increase in tax brackets from that alone. And so that's kind of the point, is that inflation and the way that they manipulate our money and the economy, we're seeing that inflation, and that inflation can have a big effect on your tax brackets. It will naturally escalate into the higher tax brackets. So as the Federal Reserve manipulates the economy, the way that's happened in the past, and with consistency of inflation, there's a good chance that that's going to push tax brackets into a higher, your income into higher tax brackets. So then that kind of moves us to the third area, your personal finances. And your personal finances are a little bit different than all of these, in that it's in your control. And so as you move through life, a couple of things happen. So you get out of college, and you go to college, you potentially take out some student loans. You get out of college, you start working, you get married, whatever, you buy a house, and you now have student loan debt and you have a mortgage, both of which that are currently tax deductible. Okay, so you're bringing down your expenses and your overall taxable income because you have these deductions. As you progress through life, those balances come down, the interest charges are less, and ultimately, if you're managing your money well, those things are paid off in the future. So if you're turning 50 or 60 and you've paid off your home, you've paid off your student loans, well, now your income is taxable to a higher level. Even if your income stayed the same and it didn't adjust to inflation, then you would see an increase in taxable income because you have a decrease in deductions. The additional thing that's happening is as you have kids and they're in the home and they start to get older, they graduate from high school, and then they go to college, they graduate from college, they're no longer an exemption on your taxes. Another reason your taxable income will go up, simply because you have less deductions and exemptions. So your personal finances are going to be a big factor on pushing that income up. In addition to that, you're going to be hopefully having increased wages, increased paychecks, advancement in your career as you have new skills and talents. So these three things together all kind of point towards taxes going up. None of them really point towards taxes going down. So the value of a tax-free retirement is that as tax rates go up, you're not subject to them. So if I'm in a 15% tax bracket today, and in 30 years I retire and I'm in a 30% tax bracket, I can take out my money. Even though there's a 30% tax bracket, I'm not affected by that. But if indeed I don't, I'm going to have to take out that money in a 30% tax bracket. So that being said, let me show you how the infinite banking concept actually works, and so you can understand how it's tax-free and why that's valuable for planning for those future taxes. So let me go ahead and clear this slate and talk to you about how this works. So the infinite banking concept is designed around a very specialized form of life insurance, and we call it high cash value life insurance. In other words, it's designed to stockpile cash and build wealth. It's not designed for simple death benefit needs, although it has those. More importantly, it's designed to build large amounts of cash. So what you have is this high cash value.